From New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, closing out a wild trading week with global central banks voicing unease, the Federal Reserve failing to push back. We begin with the big issue, a wild week for the bond market.
This week, this is pretty painful.
We got disruptive yield curve dynamics.
The belly of the curve is ridiculously steep.
We think that has more to go in terms of driving rates higher.
We're starting to see economic growth pick up.
Markets now expecting a much stronger recovery.
We're selling off because of optimism for growth.
Not the same thing as inflation.
It's a distinction that is illustrated by that rise in real yields.
For a lot of traditional long-only investors in fixed income, this is a painful process.
People are left with a lot of long duration exposure.
Lower rated parts of the market finally taking the pain and repricing to the...
That's the second wall of worry in this reposition.
The problem with relying for too long on monetary policy,
it's going to be very, very delicate.
The exit becomes difficult.
The exit becomes difficult. Let's get to the panel. TD's Priya Misra, Bank of America's Cabana, and Zach Swabe of UBS. It's become like weekly therapy for bond investors, this program has. And Priya, what a week it has been. Through the week, people kept saying it's healthy. Real yields are pushing higher. The Federal Reserve almost endorsed it. Chairman Powell said it was a statement of confidence. What was Thursday?
I would say it was not healthy. In fact, I would argue this week was not healthy. I think it sort of peaked on Thursday with these gappy moves, with a really bad auction. I think we just went from optimism on the economy, on inflation, to concern about Fed support. And when the Fed didn't push back, didn't continue to say that this was a healthy sell-off in rates, I think that just fed on itself. We also had technical factors. We had convexity paying. I think that exacerbated price action. But I would say yesterday or this week was about, is the Fed stepping away? And if they're tapering this year, can they hike next year? We're pricing in the first rate hike at the end of next year, which is crazy if you think about we're still in the midst of a pandemic. So I think the market, I would say this was signs of a broken market emerging, and the Fed needs to step in. Otherwise, I think it's just going to get worse with all the supply we have to take down.
Mark, just add to that. It is hard to reconcile with the idea that you'd have higher rates anytime soon before you've even priced in inflation that's in line with what the Fed is shooting for. Can you reconcile those two things?
Yes. Well, I agree that this is a bit of an unhealthy rate rise. It started out as a healthy rate move, reflective of better inflation expectations and better growth expectations, but it's morphed into an unhealthy area. And you can see that through the illiquidity in the marketplace, some of the very significant position unwinds that likely exacerbated the moves, and real questions about how is the Fed going to handle this? And what will they be looking for to either bring them in to stop the move, or what are they going to be signaling about the outlook for monetary policy? And we think that the Fed is really going to be challenged here to talk about how the rise in interest rates is becoming unhealthy while communicating that they actually have a better outlook for the economy at the March meeting. At the March meeting, the Fed is going to sound more optimistic. They're going to have to acknowledge that the distribution of risks has shifted from the downside to the upside. Meanwhile, you've got the bond market that is reflecting serious signs of concern about a potential withdrawal of accommodation. It's going to be very awkward for the Fed to discuss. Now, the way that they can get around this is by focusing on illiquidity in the marketplace that is not healthy, that can spill over and have negative impacts in other markets, as we saw yesterday. And they're going to have to get kicked in to acknowledge that soon. Otherwise, you're going to have a broader tightening of financial conditions. And I anticipate that we're going to hear Chair Powell begin to talk about the unhealthy aspects of the move and some of the illiquidity in markets that we're beginning to see next week.
Chairman Powell next week. On Thursday, a whole host of Fed speak. The Fed speak we got in the last 24 hours, though, this from the Federal Reserve Bank of Atlanta President Raphael Bostic. I'm not worried about that. He went on to say, I'm not expecting that we will need to respond at this point. Zach, do you think the Fed's been tone deaf in the last 48 hours?
John, thanks for having me back. I can't say whether the Fed's been tone deaf. I mean, obviously, the statement earlier on in the week from Powell certainly soothed markets, and Priya kind of explained the effect on government bond yields there. So if we focus on kind of the risk markets, the the sub-investment grade market or the credit markets, there certainly has been an increase in vol, but it's been very manageable. So in terms of tone deck, the effect on the total returns in our market, or pricing risk, or the cost of capital for borrowers coming back to the market, I don't think it's really affected a bit yet. So in terms of investment grade, which might have a longer duration profile, there's certainly some element of spread widening, which can affect marginally the cost of capital of companies. In high yield, it's probably been the most boring part of the credit markets and the fixed income market in general. Even in the worst part of the quality end, the triple C end, we've probably seen the best returns year to date as of yesterday in global fixed income. So I think as we go forward, this is when policy errors can occur. And as Mohammed was talking about earlier, policy errors lead to market accidents. For our market, credit, we're kind of okay right now, but we can talk about it as the discussion goes on.
Yeah, it's much needed perspective, I think. And I think it's important as well, Priya, to recognise that it's certainly not the end of 2018, where we saw high yield spreads blow out by 100 basis points because most people consider the Fed was making a mistake. When they look at financial conditions, Priya, do you think there is any reason to be concerned at this point, given what we've seen this week?
So I think the speed of the move worries me. And the fact that it's not driven by inflation expectations, it's actually driven by real rates. Real rates is what starts to impact the economy. In fact, that late 2018 is when real rates, now they were much higher than here. So we are in a different world, but we are in a post-COVID world. Can the economy handle, 0, 10-year real rates? We've just moved from minus 100 to minus 60 basis points in a 2-week period. So I think that's why the Fed needs to come in and at least soothe the market. I agree with the point earlier that they have a tough job because the outlook is better. So I don't think they're going to come in and say we're capping yields or we're going to extend weighted average maturity of buying, but maybe clarify that they have a more dovish reaction function, or clarify the Fed exit that they want to that they will taper. It's going to be a gradual taper. The hike is well after that. And to the earlier point about credit, if this was what I'm calling the tantrum without the taper, because technically no Fed official called it a taper, started the talk of taper. During the taper tantrum, investment grade spreads significantly underperformed. Because if I'm earning so much more in treasuries, well, I want more in credit. And if you start getting fixed income outflows, this thing can just run on itself. So far, I think the Fed is looking at spreads that are well behaved. Equities are only slightly off the highs. But if they don't the counterfactual, if they don't come in and calm the market down about Fed exit, I think these things can all quickly turn, as we saw in the Treasury market yesterday.
Pace and composition matters. And Priya, your point on pace, it was fast. On composition, it wasn't inflation expectations. I kept seeing people talk about that on networks like this and other networks too, talking about inflation and an inflation scare. But this was a real yield move. And Mark, the other interesting thing about this move yesterday in the last 24 hours was actually not at the back end of the curve. It was in the belly. It was in the front end. Now, you and I, literally a couple of weeks ago, had a conversation about the demand-supply imbalance that could lead to even lower yields at the front end. And I was just asking myself yesterday, what business does the 2-year have pushing through 12, 13, 14, 15, 16 basis points, given what we're about to see take place in the next couple of weeks? What were your thoughts about that, Mark?
At the front end of the curve, we thought that the move was overdone. We've been recommending that clients fade that, just given the fundamental cash collateral imbalance that is still going to play out. The 2-year move is a bit overdone. It's paring the moves back to some extent today, and we do anticipate that will continue as the wall of reserves, or the tsunami of reserves, washes over the front end and pushes all rates to zero. Now, the belly of the curve is, you're right, where the biggest move has been. And we anticipate that the market is not yet done repricing the belly yet, primarily because I think the market is recognizing that the outlook has improved materially, that the Fed is going to start shifting their distribution of risks to the outlook to the upside. And that is going to mean that this is a Fed that is feeling more confident to potentially at some point think about raising rates. Now, we can talk about how bond market illiquidity factors into their ability to raise rates and how it complicates their ability to raise rates. But what the market will price is it's going to price a steeper path for the Fed as they come out of the pandemic. And that's going to be supported by significantly above trend growth for years, not just in 2021, not just in 2022, but if we get infrastructure, probably in 23 to 2025, above trend growth. The largest positive output gap that we've seen since the 1970s. That's a material improvement in the growth outlook. And as that occurs, should the Fed really be hiking twice a year, which is what the bond market was pricing prior to this week?
Yep.
Probably not. In our view, that seems quite slow. And that's why we've been now recommending curve flattening positions, 530s flatteners, because the 5-year part of the curve is alive. It's alive with Fed expectations, and it's alive with the possibility that maybe the outlook will allow the Fed the potential to raise rates in the future. Now, again, the back-end illiquidity poses a challenge to that, but the market typically prices in a more rapid pace of Fed rate hikes as we get closer to liftoff. And that's exactly what's happening today. And we don't think that the market is yet done repricing the belly.
Great explainer. Mark, you're going to be sticking with us alongside Zach and Priya as well. Zach, I want your thoughts on the credit market in just a moment. Before we head off, I want to bring you some breaking news quickly on the political front down in Washington, D.C. The U.S. sanctioning 2 Saudi officials over the killing of the journalist Jamal Khashoggi. The United States saying the Crown Prince Mohammed bin Salman approved the operation. More on that a little bit later through the day on TV and radio. Up next, the auction block. Junk bonds heading for their busiest first quarter on record. That conversation still ahead. This is Bloomberg. I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction block, where we kick things off in the United States. And where else? Where else but that auction? To close out the week, the Treasury's ugly 7-year bond auction, adding fuel to the global bond rout, demand cratering with the lowest bid to cover on record, and indirect bidders taking the smallest share since 2013. And corporates blow out demand for EasyJet's $1.5 billion offering in Europe. The carrier's first bond sale since 2019 was 4 times oversubscribed. And in the junk bond market, robust demand continuing, with issuance already topping $84 billion this year, needing another $11 billion to make it the busiest first quarter on record. Back with us, Priya Misra, Mark Cabana, Zach Swabe. Priya, you touched on a 7-year auction. It was a mess, and there's more supply still to come. Now, I'm trying to understand whether that was some form of a buyer's strike or just the natural consequence of messy conditions spilling over into a bond auction. What was it for you?
I think there was definitely signs of illiquidity. Bid-ask spreads have been widening, but you have a new auction that's coming in that was well understood. The rates had been rising into the auction, so it was sort of what we would call it had set up for the auction, and yet it tailed, it did poorly. So I would say it was a bit of buyer's strike. I mean, who wants to catch a falling knife? If rates are going to rise another 50 basis points, because a lot of people had been hiding out in that 5 to 7 year part of the curve, worried about supply for the long end, the 7 years should have gone okay. So I think that tells you that there's real stress in the Treasury market. People are concerned to come in and buy if there's going to be a big rise in rates. It's the Fed exit, maneuvering that Fed exit, given how important they are in the Treasury market. I think I would read that auction as very concerning, particularly because we have a lot of long end auctions in just a little over a week from now, which is why I think a lot of focus is on Chair Powell next week. Can he bring the buyers back in for that 10-year auction or the 30-year auction in a week from now?
On the 10th of March, we've got more 10-year notes coming to market. On the 11th of March, we've got 30-year bonds coming to market. Mark, weigh in on that. Do you have those concerns too?
I do. And Jonathan, to your earlier question, what's really remarkable that's happening in the rates market right now is that the Fed appears to be losing control of both ends of the curve for different reasons. They're losing control of the front end because of all of the reserves and cash that is coming into the market, and that's what's pushing rates to zero and repo at times negative. The bill market will likely follow suit there too. But at the back end of the curve, the Fed appears to be losing control because the market is very unclear as to what the Fed's reaction function will be with regards to sharply rising interest rates. And I agree with Priya, no one wants to step in and catch the falling knife. So the Fed has to come in and act as a circuit breaker to some extent at the back end of the curve. We think that they need to say something akin to what the ECB has been signaling, that the Fed is monitoring markets. They're aware that too high of interest rates can be a problem at the back end of the curve, and that the Fed stands ready to use all of their available tools in order to ensure their maximum employment and stable price objectives. If they don't do that, the market is going to be questioning, well, how high can the move go? How fast can it continue to evolve? And there's going to be very real concern about being the investor that steps in to a rate move that could well continue if the Fed does not send some type of a signal. So again, Powell has a delicate dance to do, but he's got to address issues of loss of control, not only at the front end, but also at the back end.
Zach, let's talk about your world. Your world was very different in many ways, and you talked about it a little bit, that this was a duration story that many people in credit had been preparing for. And I just wonder in your mind whether high yield, just thinking about this a little bit further on the credit side, could be the relative winner here.
Yeah, so if we put it into perspective, remember, credit's a relative asset class. So if we just think US investment grade has about 8 years duration versus US high yield around 3.5, European investment grade around 5.5 years, and European investment grade around 5.5, European high yield around 3. So US investment grade is the worst hurt in global fixed income. Back to high yield, this lower duration asset class naturally means you have less rate volatility, but it also, if we kind of look at the previous taper tantrums or the episodes of, let's say, over 60, 70 basis points of widening, so that's 2013 taper tantrum, it's 2015, the Bund move in about April 15, the back end of 18, like you said, and even this week, in general, there's been a recovery pretty quickly in the credit markets. That means within 90 days, it's recovered, the spread widening and tightened back in. And why is that? Why is credit slightly immune? Maybe we'll leave out US investment grade for this purpose because of the lengthening of the duration of the asset class there. But why is the rest of the global credit market slightly immune from this vol? Well, first of all, we got to think about obviously the convexity there with the lower rating, et cetera, et cetera. But what I wanted to do really was focus on why is there this support here continuing for credit? And it's the negative amount of yielding debt out there. So there's the balancing act. I don't know off my head how much negative yielding debt out there. It was 16 trillion, probably down to 11, 10 trillion now. I'm not really sure. As that number continues to fall down, obviously we have more positive yielding securities. And that eventually could be the seesaw that makes, high yield potentially further down the line, possibly feel weakness. You talk about issuance, maybe we see less issuance. Why? Because it's more attractive for asset allocators to move into the risk-free rate. But there's plenty of arguments here that we can continue to go through. The relative volatility versus the S&P, for example, is much less. When S&P dividends are only trading at 1.5%, the dividend yield, asset allocators might prefer high yield. So again, we haven't seen outflows either. So there are risks we need to think about. We need to think about the risk of outflows further down the line. We did see this in a taper tantrum in 13. We did see this in 18, but because of the strength of the fiscal support from governments or monetary support from the Fed or the ECB, the market ourselves kept on buying back credit. There are plenty of other things we can keep on rolling through, but I also want to highlight something you spoke about earlier. The access to untold amounts of capital, whether that's revolving credit, bilateral loans, private credit, or even government bailouts, also gives this dampener effect on credit volatility and credit spreads. So all these confluence of reasons means that we've been kind of immune from the sell-off this week. Again, it goes back to the duration as we focused on at the beginning of the point, though.
There's your number, $12.64 trillion, just in case you wanted it, Zach. Zach, alongside Mark and Priya, will be sticking with us. Coming up on the programme, still ahead, the week ahead, featuring the US payrolls report and another appearance from Fed Chair Jay Powell. That conversation just around the corner, and a rapid-fire round as well. More still to come from New York City. This is Bloomberg. I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread. The week ahead. Coming up over the next week, we get a rate decision from the RBA on Tuesday. They've been noisy this week. Plus, the onslaught of Fed speak continuing with Presidents Bostic, Williams, Mester, Bullard, Daly and Evans all coming ahead of the big one Thursday, Chairman Powell. And then to round out the week, more claims Thursday morning. Then Friday, the big event, the US payrolls report. Before we get there, it's about Thursday. Back with us, Priya Misra of TD. Bank of America's Mark Cabana, Zach Swabe of UBS. Priya, we've talked a little bit about Chairman Powell next Thursday and what to look out for. Just run me through things. As you look across the curve now, 2s out to 30s, what's the pocket on that bond market, on that curve, that you think they're most concerned about at this point?
I think it has to be that 3 to 6 year, 7 year sector, because that's the one that moved the most. It moved a lot yesterday. It's also suggesting that the market's questioning when the Fed would start hiking, how quickly would they hike. Tapering should be felt in the long end. This is the reason I'm calling it a tantrum, is the whole tapering fear has now moved into that 5-year sector. So I think the Fed explaining to us, and I think they can't give a calendar-based guidance. I don't think Chair Powell's going to commit to staying on hold for a certain period of time, but explaining what the threshold is for them to hike, how high a bar that is on the inflation front. They want to make sure it's sustained, it's an overshoot, and then that it would be a gradual removal of accommodation. I think that's important. They'd want to contain if the Fed can control that 3 to 5 year part, they can actually put some sort of a soft ceiling on that 10-year as well. So that's really the part that I think is looking unhealthy in our view. That's the part they want to, I think, contain somewhat more.
It's been a challenge to the ECB. They're trying to contain it. It's been a challenge to the RBA. They're trying to contain it. The Federal Reserve hasn't just yet, Mark, and we spent most of the show talking about what they should and shouldn't do and how they'll respond to all of this. Just a final word on that, Mark. Priya's talking about the 3 to 7 part, just the front end through the belly of the curve. That's where they should be concerned. Do you think they are concerned?
I think that the Fed is very concerned primarily with the illiquidity that we're seeing in the rates market. They know that that is unhealthy. They know that it can have knock-on impacts to other markets. Now, it's encouraging to hear what Zach is saying about credit right now. But I do worry that if we see these types of moves continue and this illiquidity continue, it's inevitably going to spill over to credit, or at least I worry that it will inevitably spill over to credit.
Yep.
And that is going to really concern the Fed because they care a lot about the credit creation mechanism. So again, I think that they care most about the illiquidity. Now, where they're looking at the curve, look, if the belly is repricing for healthy reasons because growth and inflation are expected to be higher, then the Fed is happy to see that. But I think what they're getting signs of is that long end rates, 7-year, 10-year part of the curve, is getting to levels that could begin to constrain economic activity and have a negative feedback into the housing market and other interest rate sensitive parts of the economy. And they cannot, or I don't believe that they want to see that type of constrained activity happen. They want the economy to grow. They want interest rates to be in a position to facilitate that. And they may be encountering the issue that long end rates are rising not only too fast, but too far to begin to weigh on other parts of the economy.
Guys, we've got to leave it there. Mark Cabana, Priya Misra, Zach Swabe, great to catch up with the three of you. Thank you very much for being with us after a really, really tiring week for all of you in the bond market. So enjoy the weekend. We'll see you next week. Same time, same place, Friday, 1 p.m. New York time, 6 p.m. in London. This was Bloomberg Real Yield. This is Bloomberg TV.